The newly identified cybercriminal group, Grey Nickel, is exploiting vulnerabilities in remote identity verification systems to target financial institutions globally, according to a report by biometric security firm iProf. The group has been active since July 2023 and focuses on banks, cryptocurrency exchanges, and digital payment platforms across Asia-Pacific, North America, and EMEA. Grey Nickel employs advanced tactics such as face swap technology and metadata manipulation to bypass Know Your Customer (KYC) protocols, posing a significant threat to the digital transformation of banking. The report highlights the ineffectiveness of current AI attack detection tools and liveness detection systems, which are failing to counter these sophisticated AI-powered threats. The financial ramifications of these attacks are substantial, with incidents like a $25.6 million fraud involving deepfake technology in Hong Kong underscoring the severity of the threat. A BioCatch report indicates that over half of surveyed firms experienced losses between $5 million and $25 million due to AI-powered fraud in 2023. Additionally, a United Nations report noted a 600% increase in deepfake-related criminal activity in Southeast Asia during the first half of 2024. iProf is advocating for stronger context-aware identity assurance methods and highlights the global need for standardized incident reporting to effectively combat these threats. While the European Union is advancing anti-money laundering compliance with high-assurance digital identity frameworks, other regions lag, creating opportunities for cybercriminals and emphasizing the necessity for international cooperation.
Platinum prices have continued their upward trajectory, recently breaking the $1,200 mark and reaching a session high of $1,285. As reported by Goldman Sachs materials specialist James McGeoch, this surge is attributed to a combination of technical and fundamental factors, with speculative and ETF demand playing a significant role. The rally, which began during Platinum Week in May, has seen platinum prices approaching post-COVID highs, driven by a bullish World Platinum Investment Council report and increased speculative interest. McGeoch suggests that while the metal appears overbought, the momentum could push prices even higher, potentially reaching parity with gold, especially if Chinese buyers, historically price-sensitive, continue to purchase despite rising costs. However, Goldman Sachs presents a more cautious outlook, citing three main reasons for potential downside pressure. First, Chinese demand, which constitutes about 60% of new annual platinum production, tends to decrease as prices rise, impacting both jewelry and investment sectors. Second, the shift towards electric vehicles, EVs, in China and globally is expected to reduce long-term demand for platinum in auto catalysts. Although this transition faces challenges, such as power grid limitations and the eventual reduction of EV subsidies. Lastly, while global platinum supply is expected to remain stable or moderately increase, South African power constraints and the inherent fixed costs in mining operations could limit significant production increases. The interplay of these factors suggests a complex outlook for platinum, with speculative forces potentially driving short-term gains, while fundamental challenges may cap long-term price growth.
Tron, TRX, has experienced a notable price recovery, driven by the announcement of a stablecoin linked to former U.S. President Donald Trump launching on its network. This news has spurred trading volume and interest, particularly among U.S. traders, pushing the token from 11 cents to near 13 cents. Analysts suggest that if this momentum continues, TRX could reach 30 cents, bolstered by technical indicators showing a bullish trend. This development enhances Tron's market visibility and long-term use case, though risks remain given the speculative nature of the news. Meanwhile, Arbitrum (ARB) is showing signs of a quiet rebound, moving from 75 cents to testing the 90 cents resistance level. The recovery is supported by increased user activity and improved liquidity, indicating that long-term holders are stepping in as sell pressure decreases. A breakthrough past 90 cents could pave the way to the $1.10 range, offering potential upside for investors seeking tokens with growing user engagement. In contrast, BlockDAG is capturing attention with its significant 2,660% ROI, driven by a comprehensive ecosystem rollout and a robust technological infrastructure combining directed acyclic graph (DAG) and proof-of-work (POW). With a live testnet, 2 million mobile miners, and over $302 million raised, BlockDAG is poised for substantial growth, aiming for top 50 market cap status post-launch. Its strategic approach and rapid progress distinguish it from TRX and ARB, making it a compelling option for investors focused on long-term utility and market dominance.
Gold has surged to record highs, recently peaking at $3,446 an ounce, driven by geopolitical tensions in the Middle East, U.S. fiscal instability, and a weakening dollar. This has led investors to flock to gold ETFs, such as SPDR Gold Shares, GLD, iShares Gold Trust IAU, ABRDN Physical Gold Shares ETF, SGOL, and SPDR Gold Mini Shares Trust GLDM as potential safe havens. However, the article highlights a critical consideration for investors: the structural integrity and specifics of these ETFs, which may significantly impact their effectiveness as hedges during crises. Key distinctions among these ETFs include the geographical location of their gold vaults and redemption rights. For instance, GLD stores its gold in London, while SGOL holds its bullion in Zurich and London, and IAU has vaults in New York, Toronto, and London. These locations could become crucial during geopolitical conflicts or financial disruptions. Furthermore, some ETFs, like Invesco DB Precious Metals Fund, DBP, and ProShares Ultra Gold, UGL, are not backed by physical gold but by futures or swap contracts, introducing counterparty risk. As institutional investors continue to increase their gold holdings, the preference for ETFs with physical gold backing could intensify, especially if gold prices continue their upward trajectory, potentially reaching $4,000 by 2026, as projected by Goldman Sachs. Investors are urged to consider these structural factors beyond mere price movements to ensure their investments serve as reliable hedges in times of uncertainty.
The S&P 500 index, which had been nearing an all-time high, experienced a 1.1% decline amid rising geopolitical tensions between Israel and Iran. This conflict, marked by Israel's strikes on Iranian nuclear infrastructure, has led to a significant 14% increase in oil prices, with Brent and West Texas Intermediate crude futures rising by approximately 7% and 7.5% respectively. The heightened tensions raised concerns over potential disruptions in global oil supply, particularly through the Strait of Hormuz, a critical choke point for oil transportation. As a result, oil producers like ExxonMobil and defense contractors such as Lockheed Martin saw stock gains, while companies reliant on fuel like United Airlines and Carnival faced losses due to fears of increased operational costs. The geopolitical developments also caused a rise in the CBOE Volatility Index, VIX above 20, indicating increased market volatility. Investors have been cautious, with many institutional clients, including those of Bank of America, consistently selling off stocks over the past 5 weeks. This reflects a broader sentiment shift towards traditional safe haven sectors, such as real estate, energy, and pharmaceuticals, which have outperformed the tech-heavy Magnificent Seven stocks. Despite positive U.S. economic indicators, including lower-than-expected inflationary pressures and a stable labor market, the geopolitical uncertainty has overshadowed these developments. The consumer and producer price indices suggested easing inflation, potentially increasing consumer purchasing power. However, continuing jobless claims remain at multi-year highs, indicating a softening job market. In the realm of artificial intelligence, significant corporate activity was noted. Meta Platforms announced a substantial investment in Scale AI, aiming to establish a new superintelligence unit. Oracle's stock surged following better-than-expected earnings and optimistic projections for its AI-driven cloud infrastructure business. Advanced Micro Devices introduced a new AI server chip, securing OpenAI as a customer, highlighting the growing importance of AI in market dynamics and corporate strategies. Overall, the market's current stagnation reflects investor caution amid geopolitical and economic uncertainties, with a buy the rumor, sell the news sentiment prevailing as investors await more concrete developments.
The recent conclusion of the Free Trade Agreement, FTA, between the United Kingdom and India promises to deliver significant economic benefits, as highlighted in a recent UK parliamentary session. According to the UK's Department for Business and Trade, the agreement will slash tariffs broadly, potentially boosting the UK GDP by £4.8 billion British pounds and increasing wages by £2.2 billion British pounds annually over the next decade. UK Business and Trade Secretary Jonathan Reynolds emphasized the competitive edge this deal provides, particularly in advanced manufacturing sectors like automotive and machinery, marking it as the most favorable deal India has extended to any nation. The FTA is expected to enhance bilateral trade by £25.5 billion British pounds annually in the long term, positioning both countries as crucial partners in a strategic investment corridor. This development comes as Indian companies continue to expand their influence in the UK, with the India Meets Britain tracker reporting a record number of 971 Indian-owned companies operating in the UK. As the sixth and fourth largest global economies, the UK and India's strengthened trade relations underscore their pivotal roles in shaping global economic landscapes, with Indian enterprises increasingly contributing to innovation and job creation in the UK. This agreement is set to be a focal point at the upcoming UK-India Week, reflecting its significance in the broader context of international trade relations.
President Donald Trump's proposal to cut the Department of Housing and Urban Development (HUD) budget by 51% has drawn significant bipartisan criticism. The proposed $45 billion reduction is part of Trump's broader strategy to cut $163 billion in federal spending. HUD Secretary Scott Turner defended the cuts before a House subcommittee, stating that the objective is to improve efficiency rather than reduce service to vulnerable groups such as the elderly, disabled, low-income individuals, and disaster victims. However, lawmakers from both parties expressed skepticism about the feasibility of maintaining essential services with such reduced funding, especially concerning disaster recovery and homelessness programs. The proposal has raised concerns about its potential impact on millions of Americans who rely on HUD services. Programs like the Community Development Block Grant, disaster recovery, and housing for persons with AIDS are at risk of losing funding, which could exacerbate challenges for those recovering from disasters or experiencing homelessness. Despite the administration's intention to optimize resource allocation, the final decision on the budget will be made by Congress, with government funding set to expire in September. The outcome will significantly influence the future of housing and urban development policy in the U.S., highlighting the delicate balance between fiscal responsibility and social welfare.
U.S. consumer sentiment saw an uptick in June for the first time in 6 months, according to the University of Michigan's surveys of consumers. This improvement is attributed to the de-escalation of trade tensions between the U.S. and China, with both countries agreeing on a framework that reduced tariffs on Chinese goods to 30% from 145% until mid-August. The Consumer Sentiment Index rose to 60.5, surpassing economists' expectations of 53.5, although it remains significantly below levels seen last December. Despite the positive shift, sentiment is tempered by ongoing geopolitical risks, particularly the recent missile strikes by Israel on Iran, which have driven oil prices to multi-month highs, potentially impacting consumer spending at the pump. The broader market reaction to these developments has been mixed. Wall Street stocks fell, while the U.S. dollar strengthened against a basket of currencies, and U.S. Treasury yields increased. Inflation expectations have moderated, with 12-month projections dropping from 6.6% to 5.1%, influenced by stable consumer prices in recent months. However, long-term inflation expectations remain elevated, reflecting persistent consumer anxiety over price levels. The Federal Reserve is likely to consider these inflation dynamics in its upcoming policy meeting, although it is expected to maintain the current interest rate range of 4.25% to 4.50% as it assesses the economic impact of trade policies.
The banking industry is increasingly turning to synthetic data as a solution to accelerate innovation while maintaining compliance with stringent data privacy regulations. As financial institutions invest in artificial intelligence (AI) and machine learning (ML) to enhance customer experiences and improve risk management, they face significant hurdles in accessing usable data due to legal and compliance requirements. These challenges, grounded in frameworks such as the Data Privacy Act of 2012 and the governance standards of the Bangko Sentral ng Pilipinas (BSP), can lead to delays in AI and analytics initiatives. Synthetic data, which is entirely artificial and generated by AI models to replicate the statistical properties of real datasets, offers a promising alternative by allowing banks to test models and develop solutions without exposing actual customer information. Globally, synthetic data is gaining traction as a privacy-enhancing technology, recognized by regulators and financial institutions for its ability to facilitate innovation without compromising data privacy. In markets like Singapore, it is integrated into national privacy-enhancing technology frameworks, and its potential is being explored in secure sandbox environments. The adoption of synthetic data enables banks to conduct high-value analytics and collaborate with third-party partners, reducing the risk of privacy breaches. This approach is particularly relevant in the Philippines, where the digital payments transformation roadmap emphasizes digitalization and financial inclusion. By leveraging synthetic data, banks can enhance their capacity for innovation while maintaining trust, accountability, and resilience in data governance.
Circle Internet Group, the parent company of the USD coin, USDC stablecoin, has experienced a significant surge in its stock price following its recent initial public offering, IPO. The stock, trading under the ticker CRCL, closed the week at $133.50, just shy of its year-to-date high of $138.27, bringing its market capitalization to nearly $30 billion. This rally is attributed to the growing demand for stablecoins in the United States, as investors seek stability amid market volatility. Despite the initial surge, analysts predict a potential pullback as the initial excitement wanes, followed by a subsequent rebound. Circle, the second largest player in the stablecoin market after Tether, benefits from its U.S. regulatory compliance and involvement in the upcoming Genius Bill, which could position it favorably as corporations like Walmart and Amazon explore stablecoin usage. Beyond USDC, Circle offers EURC, a euro-backed stablecoin, and operates the Circle Payment Network, CPN, which aims to streamline international payments, potentially challenging traditional systems like SWIFT. The company's revenue grew to over $1.6 billion last year, driven by increased assets and rising interest rates, although net profits declined to $156 million from $267 million. As the stablecoin industry is projected to grow significantly, Circle's stock is viewed as a strong long-term investment, albeit with short-term risks tied to market sentiment and regulatory developments.